to SB Talks. Today is Wednesday, February 7th, and I am joined as ever by our Chief Investment Officer, Nick Ryder. Welcome, Nick.
Thank you, Vinny.
Now, today we will be discussing the Santa rally, which has continued into 2024. We'll be going through the first RBA rate decision of the new year and talking US earnings season, with 6 of the Magnificent 7 having reported so far. Welcome to all our listeners. I'd like to start, if we can, with yesterday's RBA meeting, one of the first ones in the new format. Top line, no change on rates. They stay at 4.35%, but Governor Bullock, like any good governor, somewhat hedged her bets, did make reference to the fact that she is yet to be convinced that inflation is certainly on its way back to target. What's your take from what they had to say?
Yeah, I don't think there was anything in there that was of great surprise. She did talk about inflation being a bit more balanced, the risks around that, although she talked about the costs of inflation potentially going up, being sort of higher than if it goes down more quickly. She mentioned that...
So just talk to that one a little bit more. What does she mean?
Well, they're obviously worried of sticky inflation or a second inflation wave. She talked about goods inflation coming down probably faster than what they had thought because of some of those supply chain issues being solved.
So the artificial kinks at least working away out of the system.
But did flag, and we've spoken about this on podcasts before, about services inflation being stickier and it's been more gradual to fall. And so I think that's really where their concerns are, that the economy is still pretty strong by and large, that we've got strong population growth, and that's adding to some sort of demand pressures in the economy, which is keeping that services inflation a little higher. We also got, under the new format, the quarterly statement on monetary policy, which has their new forecasts, right. And that was released at the same time as the statement yesterday. Normally it kind of comes a few days later. So they've tweaked their forecasts a little bit, so they do see the economy maybe slowing a bit more, inflation coming down a tad faster than what they'd previously penciled in, as well as unemployment maybe being a bit higher than what they had previously. So they now see unemployment getting to 4.4% by middle of next year. I think that was 4.25% previously, and they see the inflation rate getting from currently 4.2%, which was the latest quarterly number, down to 2.8% at the back end of next year. And that was 2.9. So a small tweak.
So we've got a target band there of 2 to 3%.
Yeah.
They're technically aiming for the middle of the target band. That's been sort of more clearly defined in recent times. So they're sort of arguing that they're edging in. I think some of those figures, unemployment, softening a little, but from a very tight employment space as well. So not a huge amount to move with.
She did talk about the labour market softening a little, but still not being consistent with inflation at target in that 2 to 3% target range and full employment. So she's still saying that even though we've seen a little bit of weakening in the labour market, it's still not consistent. It's still too tight, really. So I think that was interesting. The other thing...
Just to touch on that, because really the key part of all of that is really all well and good on the data. When are we likely? Because there's been this wave of optimism. We've had it offshore, and we'll come to that. But starting to drift to local markets, that we would be seeing some rate cuts. And when might they be, and how aggressive might they be? Fair to say, don't hold your breath.
Yeah, so they did change the language, so they removed the explicit reference to further rate hikes potentially being required. Okay. But they now say they're still cautious that further rate rises cannot be ruled out. So it's a small tweak, and it was slightly different. Like the press conference afterwards, she was probably a bit more balanced. So I think the statement was really designed to try and push back on any notion that there'd be imminent rate cuts.
Now let's just talk to that for a second, because we've got the press conference afterwards, which is part of some of the newer measures being rolled out, sort of somewhat similar to what they do in the States, where Jay Powell has to rock out and answer a bunch of questions, and the market leaps up and down on every word in those answers. Of course, you were glued to that press conference. What was your take? Is there anything? Do you think it will give us better clarity in terms of what they're thinking, or is it very carefully managed, as any RBA governors should expect?
I think it was pretty carefully managed. As I mentioned, she was probably, when she spoke, it was more, oh, we're not ruling anything in or out. So it was more balanced, whereas the statement said we're not ruling out rate rises. Yeah. So that was more sort of, and in the upside.
And in the statement, it's always not so much, it's not just what's in that statement, it's what was in the prior statement and what direction has it moved in. So they've gone from, the potential need for increases to not ruling out increases. Well, that's a half a step, if you will, in towards the right direction, but let's not get carried away.
Yeah, I think so. I think, if inflation is not coming back to target quickly enough, we can't rule them out, although I don't think anyone is really expecting that. And the market pricing for rate cuts in Australia is 1 cut by August, and 2 by December.
So assuming 25 basis points out by August, or markets pricing that in, and potentially a second in 25 basis cut later in the year. Did that move much on yesterday's announcement?
I don't think so. No, I didn't check immediately before, but I don't think it's moved dramatically. So I think, the Australia market's probably 6 months behind, places like the US and Europe, where they're talking about cuts potentially in May. Yeah.
And you've been of the view for some time that there would be cuts, but possibly some of the excitement about those cuts was overdone and that they would come later. You talked there about when the market is pricing in those cuts. What's your thinking?
For Australia?
For Australia specifically.
Yeah, I think that they want to just be, see more data, see more progress on services inflation. We do have the stage 3 revised tax cuts kicking in July. And I think, whilst, they've kind of changed who's getting those, the aggregate amount is not that different. So she said it's not having a material impact on their thinking, but
it's not having a material or immaterial?
It doesn't have a big impact on their thinking.
As in they were already pricing in that these were coming. It was going to be inflationary potentially.
Correct.
And they still expect it to be.
Yeah, and some economists have said it's equivalent to a couple of rate cuts, potentially the size of the aggregate tax cuts that are flowing through, and particularly if they're flowing through more to the lower income earners, they tend to spend more.
They spend a larger portion of their disposable income.
So,
and those sort of rate cuts, if they come in July, it's going to take a few months until we probably see the impact of that. The people feel it in their pockets and then get the confidence to spend it.
Yeah. So you can see why the RBA is kind of pushing back and the market's pushing those rate cuts back to the back end of this year.
Reason for caution.
Yeah.
Now, there were a few other changes. We've had the press conference was one of the changes, and you referenced a couple of others there, talking about yesterday's meeting. One of the others was the voting, publishing of the voting, but we don't get that just yet. Quite a potentially dangerous precedent that everyone that's on the board is now going to be publicly, I guess, accountable, or at least visible in how they voted.
Well, it won't be attributed to individuals.
Okay.
It'll just show the, I believe, the numbers who voted for and against for a hike and things like that.
And then the speculation can be who voted what way.
Yeah.
It's not a huge board.
That's right. I think that requires legislation, which is more likely that will come in July, I believe.
Yeah. Very good. Perhaps we step across to the US, and their economy seems to continue along its narrow path in terms of the rates increases that they have done, and obviously speculation about cuts to come, and we can talk to that. But the economic data as it flows through remains incredibly robust, and most recently employment figures.
Yeah, so we had a very strong non-farm payrolls number come out on Saturday morning our time. 353,000 jobs created in January. That was double what the market had expected. And it wasn't just that. There were substantial upward revisions to prior months.
Right.
Now, some people say, it could be, seasonal, cold weather and all this sort of stuff. So maybe don't read too much into it. But with the revisions to the prior months, it does show the US economy is very strong still. We've also seen manufacturing and services PMIs come in stronger. So, in the last week, I've seen two sell-side firms get rid of their recession calls for this year and now say soft landing. So that's, there's some of those guys have been dragged there kicking and screaming, but they just can't deny the strength of the US economy. And
it does call into question the optimism with regard to rate cuts and how soon they're going to come and how aggressive that they'll need to be if the economy is still so robust.
Yeah, I think that, well, certainly the labour market is robust, and I don't think anyone's saying that if inflation continues to fall, and it is coming down reasonably quickly, that even with a strong labour market, that would preclude rate cuts. You could still have rate cuts with a strong labour market and inflation kind of coming back to target.
I guess it would probably depend on how far away from the mean long-term interest rate that the Fed think that they are.
Yeah, so, look, they say that 2.5% is a neutral rate. Other people are saying it's probably in the low to mid threes, and they're at 5.40 roughly. So they don't need to keep rates as restrictive with inflation kind of on track to be back at 2%. And, they sort of have, similar to Australia, dual mandate of full employment and stable prices. So
they'll come under increasing pressure if inflation continues to track in the right direction. To really, what's your justification for continuing to keep rates probably as high as they are?
Yeah, but they're going to proceed very carefully. They don't want to ignite a second wave of inflation or to cut rates before they're convinced that inflation is sustainable. And they talk about this word sustainable, sustainably kind of heading towards 2% or at.
So not basically saying they're not getting too overexcited by any individual figure that they get. They really want to see a clear trend there, both headline and underline.
Yeah, they said they like the data, but they want to see more of it.
Right. Yeah. And I'll ask you the same question I asked you before. You've been in the camp of, I think, that there's rate cuts coming here, but not getting overexcited about how aggressive and how soon they come. Where do you sit now on that?
Yeah, I think the market's probably, kind of late last year, I think in November, December, particularly when I wrote the investment outlook for 2024, I said I think markets had kind of, priced in too many rate cuts and coming too quickly. They had them in March, so we've seen, with the Fed, and not just the Fed, ECB's done the same, push back on it, really. They've now pushed those rate cuts back a month from March, or sort of one meeting from March to May, and that's probably looking more realistic. Some Fed officials have said the summer, which could be June. So I think sort of May, June looks kind of right for the first rate cut.
And of course, it's not just the first one, it's how quickly the ones that come after that. And so I think we've got an environment here where they're going to proceed with caution, and that makes a lot of sense.
Yeah, and the market's kind of moved on from the inflation story now. It's really all about growth, So last year, everyone was worried about inflation and more rate rises. Those fears have really largely dissipated, and it's more, okay, well, how's the economy? Let's focus on the economy and growth and earnings and all that sort of stuff.
Let's come to that, because good news, we do look like soft landing is more the case. Inflation, touch wood, the worst of it is potentially behind us. Rate cuts, regardless of timing, they are likely to be coming. We're heading into an easing environment there. Markets priced a fair amount of that in late last year in terms of equity markets, certainly US equity markets, particularly the Magnificent Seven, as we've talked to before. So for the markets to continue on that trajectory, we will need, I guess, to see the earnings flow through. We are about, give or take, halfway through earnings season. You wrote in your monthly, we've seen six of the Magnificent Seven reports so far. What's your take on what we're seeing?
Yeah, well, the results of the six, leaving out Tesla, which has had some issues with sales and production recently, the other five that have reported have been good. So we saw Meta declare its first ever dividend and increase the size of its share buyback. Alphabet, the Google parent, did well. Amazon had pretty good results. So the results have been pretty good. And if you look at them in aggregate, they've grown their revenues over the last year 14%, assuming that Nvidia, which reports later this month, kind of comes in line with target. $523 billion of revenue for the quarter, which is just massive, 14% growth. Now, contrast that to the other 493 companies in the S&P 500 index, and they've only grown their revenues 2% over the last year. So, 7 times more growth from those companies, and they're trading at a premium of around 30 times versus roughly 16 for the Magnificent Seven. So, in my mind,
how does that make you? How do you think about value in that market now, when you have that dynamic at play, that sort of a disparity in terms of valuations, disparity in their growth rates? Do you feel just broadly confident that that's an area that's still happy to be allocated to at current levels?
Yeah, I am. I look at something called the price earnings to growth ratio. So if you take the PE and you divide it by what people are forecasting the earnings growth to be, that comes in around 1.6 for the S&P 500.
Which is basically what PE premium are you willing to pay for growth?
Growth, yes, absolutely. That's about 1.6 for the US market. And guess what it is in Europe? 1.6.
Okay. For no growth.
For no growth. Yeah. So Europe's a lot cheaper, but it's got lower growth. So kind of and both of those numbers are kind of in line with the long-term average. So I don't think, I think the US market is roughly fair value, particularly when you bifurcate it between the Magnificent Seven and the ex-Magnificent Seven.
And clearly the market is pricing them very differently, as you correctly articulate. Okay, well, we continue to watch that earnings season, but you guess you sell a picture there of sort of confidence and probably optimism. Any other things globally? We spoke a bit on the last podcast regarding China and efforts to stabilize their share market, potential stimulus and a bit of artificial injection into that market. Is that having any impact? Has that developed at all?
We did see a short-term bounce, but their market continues to be very weak. It's down about 20% year to date. So whatever it is, the first 5-6 weeks of the year down 20% is a lot.
Particularly when you consider the Santa rally in other markets has continued apace in January.
That's right. So, they continue to announce, measures such as preventing short selling and brokers trying to prevent selling measures and total return swaps and all these little band-aid measures to try and stop people selling, really. And those tend not to work. They have a short-term impact, but largely what does it do?
It's hard to fight the market.
Well, it just discourages investors from investing. So it might be that people can't sell or can't short the market, but it stops proper price discovery. So I think that's a market that's still got some long-term structural issues. As cheap as it is, I don't see any near-term reason to be.
Okay, you preempted my question there. It was like, at what point does the prices get you excited, but not yet?
Yeah, I mean, we do. Some of our fund managers have stocks there that have unfortunately been sort of caught up in the derating and what's going on. And so, we wouldn't be looking to add there. We have other fund managers that, diverting more of the attention to India. I think there's a lot of excitement around India. That's, it's done very well, the stock market. So arguably it's in the price, but I think there are better parts of the emerging markets to be looking at,
focusing on right now. Excellent update as always, Nick. Thank you very much. Take care. Thank you to all our listeners.